Welcome to another video. This is Sam Morton from technicalforex.com, and this is the last lesson. It's lesson 3 of 3 with the Forex Basics course. The Forex Basics. This is lesson 3. How do you make money trading Forex? Now I'm quite excited to get to the end of this Forex Basics course because it's the next lesson that really excites me, and that's all about technical analysis and reading price charts. This is a price chart here. This is what price charts look like. They also look like this, candlestick charts. And my style of trading is analyzing these charts and then buying and selling currencies according to my analysis. And that's how I trade. And that's what really gets me excited about trading, is analyzing charts and then making trades accordingly. And this will be covered in the next course. But before we move on to that, you need to know how we make money, or how you make money trading Forex. So the first question that it asks on this page is, how do I know when to buy and how do I know when to sell? There are two forms of analysis when it comes to trading. The first is technical analysis and the second is fundamental analysis. This is technicalforex.com, which very much focuses on technical analysis. Now, technical analysis is analyzing these charts. And there are many ways that you can analyze price charts. There are generally two main ways. The first is price action analysis, meaning we take this chart as it is, and from this chart we predict where future price is going to be. Another form of technical analysis is using indicators. So some traders will have all sorts of lines and indicators on their charts, which will help them to identify where price is going to be in the future. And let me bring up some indicators to demonstrate this. Okay, so here we go. This is a chart with technical indicators on. We have all these lines and dots, and all of this will be explained in a future course that covers indicators. And this is what a chart can look like when someone uses technical analysis, and more specifically indicator analysis, to identify where future price is going to be. A trader that uses price action analysis doesn't use these indicators, but uses the pure price, sometimes what traders call a naked chart, to speculate where future price is going to be. So a price action trader, his or her chart might look something like this. Okay, still we have lines on the chart, but it's a lot more simple and straightforward. And then some traders use both. They use some price action analysis and some indicator analysis. But hopefully you can tell by my voice that I'm getting excited about this, because this is what I really love about trading. And this is what has made me money trading, is analyzing price charts and then making trades according to my analysis. Now, some traders don't use technical analysis. They actually use fundamental analysis, and that's analyzing and predicting the news, things like interest rates and other news and economic data that has an impact on currency price. This site doesn't go into too much detail about fundamental analysis, but there may be a course in the near future about using fundamental analysis. And once again, just as some traders use price action analysis and indicator analysis as part of their trading, some traders actually use fundamental analysis and technical analysis. They use bits and pieces of all forms of analysis for their speculations. Technical analysis is very popular in the Forex markets, and most retail traders, that's you and I and most other people that trade from home and trade with their saving or a small amount of funds, are retail traders. Now, you trade the currency markets by using a currency broker or a Forex broker. A Forex broker will offer you access to the market, and you'll be able to buy and sell Forex pairs using your broker. Your broker will make money in a number of different ways. This is usually done by fees that they charge. The biggest fee is the spread, and that's how most brokers make their money, is through the spread. So you'll notice here that we have some Forex pairs: the Australian dollar, US dollar, the euro, Swiss franc, the euro, US dollar, the pound, US dollar. We have these pairs. We have a sell price and a buy price, and the price is actually different. There's a difference between the sell and the buy. That difference is the spread. So say the euro US dollar is currently trading at 1.1010. Your broker may offer the euro US dollar at 1.1012, so a 2 pip spread, or to sell the euro US dollar, to go short the euro US dollar, 1.1008. So once again, a 2 pip spread, and that difference they bank, and that's how they make some of their revenue. Now, there are lots of different types of brokers, and I have links to brokers here, here, and here. With each of these brokers, you can open a practice account where you don't have to trade with real funds. You get a demo account to trade with, and the details for each types of brokers are here. We have spread betting brokers, which are very popular if you're outside the US. Here in the UK, spread betting is becoming very popular indeed. We have CFD Forex brokers, and then we have true ECM brokers. If you read the details for each of these on this page, and then open an account accordingly. If you are in the UK, I would suggest a spread betting broker. If you're in Europe, I would suggest a CFD broker. If you're in the States, then you'll need a true ECM broker, and you can open an account by clicking this link. There are a few other things to mention on this page and before we move on to our next course, and that is Forex orders. You can obviously buy at market, or what we call buy at market, where you'll just click buy the Australian dollar, US dollar, and you'll open a position. You'll buy that currency pair, that Forex pair. But you also can put in orders in the market to buy or sell at a specific price. So going back to the euro US dollar example, if price was at 1.1010 but you actually wanted to buy at 1.1020, you can place an order called a limit order to buy at 1.1020. So when the euro US dollar reaches 1.1020, your broker will open that position for you. Along with limit orders, you have stop losses and take profits. If you want to close your trade down at a specific loss or profit, your broker will do that for you, and they are called stop losses and take profits. So if we opened at 1.1020 and we wanted to take profit at 1.1030, so a 10 pip profit, we could place a take profit at 1.1030. If we wanted to close our position in a loss at 1.1010, we could place our stop loss at a 10 pip loss at 1.1010, and when price reaches that level, the broker will close the position down at a loss automatically for you. And then the last thing to mention is leverage. So leverage enables you to hold large trading positions with a small amount of capital. Brokers can offer anything generally from 1 to 2 leverage to about 1 to 500. The ratio being the amount of capital you have to place in a trade, which is referred to as margin, and the amount of capital that your broker will offer to place on your behalf. The broker's money is always ring-fenced, it's safe. It's only ever your money that is at risk. But if we have a 1 to 10 leverage, say, and we put £100 or $100 into a trade, we can actually hold a position that is worth $1,000 or £1,000 because it's a 1 to 10 leverage. So if you're trading at a leverage of 1 to 100, you can potentially hold a £100,000 or $100,000 position size with just £1,000 or $1,000. But the most you could lose in that position is your £1,000 or $1,000. If it's likely you're going to lose more than that, the broker will close the position for you, and that's called a margin call. And the broker does that as it does not wish to risk its own money in your trades. Hopefully that makes sense. This video has gone on a lot longer than I anticipated. I do apologize if I have gone too quickly, but please just reread and rewatch this video, and I'll see you in the next course. Thank you so much for watching.